Hello students, Professor Watts here again, and today we're going to talk about policy goals and rules, how the Federal Reserve or central banks in general go about implementing monetary policy in order to achieve their goals of macroeconomic stabilization. So we'll talk today about three major policy frameworks, and those are monetary targeting, inflation targeting, and nominal GDP targeting. So let's start with monetary targeting. Milton Friedman was a big advocate of monetary targeting, and he realized that you had to dial down the rate of money growth in order to control inflation. And we'll think about that here momentarily with respect to the equation of exchange. So here's what Friedman proposed to have a central bank implement a very simple policy rule or policy framework that could control inflation. Friedman says the stock of money should be increased at a fixed rate year in and year out without any variation in the rate of increase to meet cyclical needs. The goal of this policy was to control inflation and to give the public confidence that the central bank would not engage in excessive money printing and therefore control inflationary expectations going forward. We're thinking about the dynamic version of the equation of exchange, which by now we're hopefully very familiar with. So Friedman says lock in the rate of money growth at something like 3%, presuming velocity is stable, meaning it's not changing year to year, or not changing much, so we can just write down a 0 for that. What should we reflect over here? Well, we should see that real factors in the economy, land, labor, capital, and technology, will give us whatever real growth rate is possible and sustainable. And historically in the US, that's something around 3%. And if all of the growth in nominal spending, which would be M and V together, is taken up by growth in real output, how much is left for growth in prices? None, right? So that is kind of the idealized version of what this would give you in a perfect world. Now the problem is, of course, we don't live in a perfect world, and velocity isn't stable. That's going to be the big critique of a Friedman-style monetary target money growth rule. So if velocity is independently going up or down based on demand shocks, which of course it can and will do, then you might want changes in money growth to offset that. Otherwise, you're going to wind up with some inferior macroeconomic outcomes. Sticky wages also implies the need for inflation, and you'll recall like one of the big empirical concepts of Keynesian economic thinking is that some prices don't adjust nearly as easily as others, and in particular wages, they adjust very slowly and they do not adjust downwards at all. So we have sticky wages that can't adjust downwards. Well, if we need to cut wages for certain kinds of workers in certain sectors of the economy, you can't do it through nominal cuts. So what has to happen is real wage cuts due to inflation and due to wages not keeping up with inflation. So the only way to get needed wage adjustments is through real wage cuts. You need some inflation happening in the system, and you might need some variable rates of inflation. And then finally, the issue of central bank requiring freedom of action to respond to issues that arise that are surprises like financial crises. Now, the issue of discretion brings up this very important ongoing discussion in macroeconomics and monetary economics known as the rules versus discretion debate. And I just want to spend a brief minute kind of highlighting this and the contours of the rules versus discretion debate. What is some rationale or reasoning for a rules-based framework? Big one is that the policymakers at this Fed or any central bank, often they will say that they want to stabilize the economy over the long term, but like any of us, they tend to be more myopic and focused on short-term goals. And there is tremendous evidence that historically they have been politically motivated and captured by the political process, and that has led towards very short-term policy making, even if that comes at the cost of long-run economic damage, for instance through causing high and variable inflation that distorts future economic growth. So the idea of a rule that's clearly stated and then held to is idea of locking in policy to achieve long-run stability. Furthermore, we have issue of information problems. Do the members of the Federal Reserve Open Market Committee know more about what these values should be? Money growth, interest rates, inflation. Well, maybe not, the argument goes. And so maybe we should just lock them into doing something very predictable and very transparent, and then let market forces decide the specifics for those variables And that might be superior to having the Fed make guesses, right? We kind of have a central planner's dilemma here. The central planners don't know the information, and so anything they do would be guesswork that could often as not be wrong and cause destabilization. And then finally, there's an issue of a time inconsistency problem. Policymakers have incentives to say one thing and do another. They have incentives to say something that the market wants to hear that indicates that they are interested in maximum growth and long-run stability, but then kind of maybe surreptitiously undertake actions in the short run that undercut those stated goals of long-run stability and optimal growth. So to prevent time inconsistency problems, if you could tie down the policymakers to commitment to long-term transparent rules, that might be the best solution. Now, discretion, on the other hand, basically cuts against the rule-based policy framework by saying, well, you don't want to tie yourself down into an erroneous rule. Rules are inflexible, and because we face uncertain shocks and surprises, if we tie ourselves down into a rule, we might be committing to the wrong policy, right? And as we just stated with respect to a monetary growth rule, what if velocity changes? You tie yourself down to a fixed money growth rule and you see velocity collapse, and you could be looking at deflation. A classic debate in monetary economics: should we tie the hands of the central bank monetary policy authorities to prevent them from causing economic harm, or should we allow them discretion to prevent them from causing economic harm? And let's look at the issue of, in monetary targeting, if you were to have a significant change in velocity. So let's say velocity goes down at, let's say, 3%. Okay, you hold yourself to that fixed money growth rule at 3%. So what is the total change here in total spending? Well, now it's zeroed out, right? 3 minus 3 is 0. So that means the total change over here in total purchases, total spending, has to be 0%. In an ideal world, we could keep growth at 3% if real factors were the same, but that would require a 3% deflation rate, which might be harmful for reasons we've talked about before. Sticky wages issue in particular. Can you have wages fall at 3%? Well, no, wages can't fall at all, and if other prices are falling but wages are not, firms could get into a situation of seeing reductions in their profitability, and that would force them to cut back on assets. And then you also get into issues of debt deflation and debtor creditor problems with deflation. So that invokes a whole mess of adjustment issues, right? Might be better, a lot of people would say, to just let money growth rise to, say, 6%, and now we've got a plus 3% growth in total spending here, and that would allow us to achieve something like zero inflation and 3% growth. Or maybe better yet, the inflation targeters might argue to have money growth go even higher, and then you could have some positive inflation, and positive inflation allows for easier relative price adjustments than even 0% inflation, again in the face of sticky wages and prices. So plenty of arguments against a kind of simplistic monetary target. So that brings us to inflation targeting. So given the shortcomings of monetary targeting, many central banks around the world begin saying, well, let's just target the inflation rate. We'll let the money supply grow at whatever rate is proper to just achieve a given inflation rate. And that could allow for coping with unexpected changes in velocity, changes in spending. And it also still allows the central bank to be committed to doing what they can do and what is necessary for arguably keeping the growth rate stable, which is keeping inflation within certain specified bounds. Let's think about inflation and the central bank's ability to control it. And you've probably heard me use this pulling on a string metaphor if you're in my class before. You can pull on a string, right? Imagine you have a helium balloon. You can definitely pull it down by pulling on the string, but can you raise it by pushing on the string? No. So monetary policy likewise can definitely reduce high inflation. It can definitely pull inflation down by reducing the money growth rate. Monetary policy furthermore has an ephemeral effect on output. What do we mean by that? Well, if you have high inflation and monetary policy takes steps to pull that down by reducing money growth, by reducing aggregate demand, you'll have higher interest rates, less borrowing, less spending, and a recession is very likely in the short run. But once the economy adjusts to the lower inflation environment, interest rates can then fall. People can adjust expectations for wage and price growth downward, and then the economy can get back on an optimal path of output growth at the lower expected inflation rate. And that's exactly what we saw in the United States in the early 1980s recessions. After a very severe double dip recession, the public came to understand that inflation rates were lower and the Fed was going to keep them that way, and so the economy started growing again very rapidly at a much lower inflation rate. And then on the other hand, to try to stimulate the economy through renewed bursts of inflation, those wear off too, because people just adjust their inflation expectations upwards, and this is what had happened through the 1970s. Therefore, inflationary stimulus has to involve larger and larger increases in inflation to have ongoing effects. But of course, then you wind up with unacceptably high inflation rates. And in the United States, again, we had consumer inflation rates hit 12, 14%, and that's at that point they became unacceptable. So you can't do much stimulus with inflation. Inflation targeting is introduced to have central bank policymakers focus on the one thing they can control, which is the inflation rate. They can definitely bring inflation down, and of course they can engineer higher inflation as well if they want. As we just discussed, though, central bankers probably don't want to attempt to continually stimulate an economy through inflation, but they could bring inflation up if it's too low. If we're in deflationary territory and a central bank wants to get inflation above zero, well, they can definitely do that just by adding enough money to the economy. And then if inflation's too high, they can definitely control it by bringing money growth down. So we know the central bank, the Fed, can control inflation. So most central banks in the world since roughly the 1980s have adopted some form of inflation targeting with a single mandate. The government tells them, hey, just keep the inflation rate on target. That's all we want you to do. So here's how inflation targeting works. A central bank will make a public announcement of a numerical inflation target, 1%, 2%. Usually it's a range between, let's say, 0 and 4%. And then they undertake monetary control tools, which we've talked about before, usually interest rate targeting policies, occasionally money supply target, in adherence with achieving that specified inflation target. And as I just mentioned, pure inflation targeting makes the central bank a single mandate institution. When the inflation target is credible, meaning the public and financial markets have confidence that the central bank is actually going to achieve it, well, then they will. Inflation will be low and stable, and that contributes to long-term growth. Variable inflation wreaks havoc on real interest rates, and that's what causes your problems. Variable and then growing inflation is what can destabilize an economy. Inflation targeting then will increase the policymakers' accountability and help establish their credibility. Here's a case study of inflation targeting. New Zealand was one of the first countries to go into a single mandate inflation targeting regime with their central bank. And as you can see from the chart here, New Zealand was suffering from a very high and variable inflation rate here through the 1970s with the oil price shocks. They had inflation approaching 20%, and it's highly variable, 18%, 10%, 18%. Then they're way down here with a wage and price freeze, but that's very painful for the economy. So they've got very volatile inflation, economically destabilizing, and the central bank's not helping. So they introduce a inflation target. They phased in a 0 to 2% range for their inflation target starting in 1990. And I found a small interview from the Royal Bank of New Zealand Governor McDermott, who oversaw the implementation of this. The keys to success were that they had central bank independence, so they weren't beholden to political or fiscal needs. They were transparent. They had frequent reports and a very public target, and a single objective, single mandate, meaning that they only had one job to do, right? The old adage says, if you're the jack of all trades, you're the master of none. Well, to avoid that, you specialize in doing just one thing and doing it well.
You had one job. Just the one?
They also had a single decision maker. This makes them different from a lot of other central banks. The Fed, of course, has the Federal Open Market Committee. They just had the governor implementing this policy all by himself. So New Zealand was seen as a great success story and an inspiration to a lot of other countries to follow suit and adopt an inflation target single mandate. So enter the Taylor Rule. Now the Taylor Rule is named after the very well-known monetary economist John Taylor of Stanford University. And the Taylor Rule was discovered by Taylor trying to fit a reaction model to the Fed's policymaking during the Great Moderation period. The Great Moderation is basically the period between the end of the high and volatile inflation of the 1970s, which pinpoint the end of that to basically about 1982-83, up until the housing crisis, the subprime mortgage crisis, and financial crisis and recession, which the financial troubles there begin in about 2007. So it's about 25-year period here under which the Fed brought inflation way down from the double digits down to a pretty reliable 3 or 4%, and growth was very strong, and recessions in this period were pretty brief and mild. As I mentioned, the inputs here involve the dual mandate. So we're looking at both inflation and output, or real GDP growth. In just a moment here, I'll walk you through the Taylor Rule formula, and we'll run some data through it and see how it actually works. And Taylor found the Fed's interest rate target could be modeled as follows. So he set up an equation. Target federal funds rate, which is what the Fed needs to set, remember, because they're using interest rate targeting to achieve their policy objectives. So the target federal fund rate starts off as the natural rate of interest. So this would be the real rate of interest for short-term money market loans. Tack on the current inflation rate, okay, and that kind of reminds us of what? Well, that component of the Taylor formula reminds us of the Fisher equation, doesn't it? So this kind of looks like I equals R plus pi, right? So we've got the Fisher equation, and then the reaction model part is going to take a weight times an inflation reaction component, which we will call the inflation gap. So this is the difference between the targeted inflation rate and the actual inflation rate we're experiencing in the most recent period. And then a weight and an output gap. So we have the inflation component of the dual mandate here, and then we have the employment/growth component here. And the output gap is the difference between what's presumed to be the sustainable potential growth rate in the economy based on full utilization of real factors and the actual GDP growth rate we're experiencing. Yeah, here we go. The natural rate of interest is the real short-term interest rate that prevails when the economy is using resources normally. Taylor originally used 2%, which is close to the average real short-term interest rate over that time period. Now, there's a lot of debate about this. Has the real interest rate gone down in recent years with a lot of uncertainty and a lot of maybe a savings glut? Inflation gap, current minus targeted inflation, as we just mentioned. When inflation exceeds the target level, we have a positive inflation gap. That's going to pull the suggested policy rate up, and vice versa if the inflation gap is negative. Then the output gap is a percentage deviation of current output, real GDP growth, from potential output. When current output is above potential output, we have a positive output gap. That's going to put upward pressure on the suggested policy rate, and then vice versa if that output gap is negative. Okay, so let's take a look at the Taylor Rule in Excel. And all I'm doing here is I'm just running the equation in Excel. So as you can see, I've got the equation spelled out here. Taylor Rule, I, the policy rate, equals R star, the real interest rate, plus pi, the actual inflation rate experienced. I think Taylor had it for the previous year. And then the weight times the output gap, so W1 times Y hat, plus the weight on inflation plus the inflation gap. So here's the weights for output and inflation. Those can be tweaked. Taylor set them at 50-50 basically, so they're equally weighted, but if you wanted, you could put more weight on inflation, less weight on output, and vice versa. And then the output gap, deviation of actual from potential GDP, and here I'm just going to plug those numbers in. Potential GDP is set at 3%, as I've mentioned. That's pretty much the long run average real growth rate for the US. And then the target inflation rate, the Fed has been targeting, I think I've mentioned this, a 2% inflation rate since 2012 explicitly, so that's why we choose that at 2%. And then we'll plug in the actual observed values for GDP growth and inflation here, and then we'll see whether we get an output gap or an inflation gap here. If you get stuck on what's going on in the equation, just maybe pause the video and study the little key here for all the different terms. You'll have the opportunity, if you're in my money and banking class, to work through this in homework 5. Okay, so we'll start off at our baseline scenario where there's no output gap. So the economy is running at potential GDP growth. Output gap is 0. So that means the output gap component of the equation is 0. Okay, and likewise, inflation is running right at target. So there's no inflation gap. That's 0. And you'll notice that the inflation gap component of the equation is 0. So these don't contribute anything. So all the policy interest rate is, well, it's a Fisher equation. Real interest rate plus actual inflation equals nominal interest rate. Now, what will happen when we have deviations in either inflation or output? Well, let's start by having inflation start to rise. So let's take inflation to 3%. Now I've got a 1% inflation gap, and we're going to increase the target rate by, well, 0.5 times that 1% inflation gap. So that's going to increase it by 0.5% or 50 basis points. And then, because the actual inflation rate is also fully in the equation, we're going to increase, and that went up by 1 percentage point, 100 basis points. We're actually going to wind up increasing the interest rate by 150 basis points. So notice that the increase in the policy interest rate runs ahead of the increase in inflation. How much did inflation increase here? 100 basis points. How much did the policy rate increase? Well, 150 basis points. So this kind of will push the interest rates up higher than the rate of inflation, and the idea there is you want to really tamp down on whenever inflation starts to build up. You want to have a proportionately higher change in the interest rate to tamp down on the level of excessive borrowing and spending that arguably is driving that inflation rate. Likewise, let's say we had inflation go down. Let's say inflation went to 1%, a little bit of disinflation. Well, now I have a negative inflation gap, and that's going to do the opposite. So that's going to put downward pressure on the policy rate now, and again, a 100 basis point decline in the inflation rate causes a 150 basis point decline in the policy rate. Let's take inflation back to target, and let's see what happens when we change output. So when we get an output gap, well, let's have a positive output gap. Growth starts to overheat and going above the potential up to 4%. Well, now I have a positive output gap here, and we are going to push the policy rate up, but now only by half of the output gap, because the weight times the output gap dictates the increase in the policy rate. So as real growth rises, we're going to see that the policy rate gets pushed up, but only by a fraction of the increase in real growth. If real growth goes down, let's go to 0. Well, you see we're going to get a policy rate cut, but again, only by a fraction of the change in the growth rate. What if we go into recession? Well, we're going to see increasing reductions in the policy rate. And the goal there, of course, is as the economy goes into recession, the central bank wants to stimulate lending, borrowing, spending, aggregate demand. And their tool to do that is to ease credit conditions, theoretically, by reducing the policy rate, which will cascade into reductions in other interest rates. And in the next lecture, we'll talk further about the channels by which that interest rate adjustment is supposed to have the intended effects. Okay, so we can run through all kinds of scenarios here. We could run through, maybe we could have an inflationary boom in the economy. Let's say growth is above potential and inflation's above potential. Well, then see, we're going to have significant increases in the interest rate, the policy rate, to try to tamp down on that inflationary growth. What if we had an inflationary recession? Let's have growth way below target and inflation picking up. Well, you see the interest rate's going to be set to some kind of moderating stance. Let's look at a deflationary depression now, and this is where you get into limits with the Taylor rule as a policy framework, because if we get into a deflationary depression, this says, well, you need a negative nominal interest rate, and the Fed is unwilling to adopt that. It's technically feasible to have a negative nominal interest rate. The simplest one would be to have banks actually charging depositors for the privilege of putting money in their accounts rather than paying them interest on deposits. Of course, that is kind of unfashionable and probably unfeasible in the United States as well. So the Fed has indicated a reluctance to even really talk about trying to implement such a thing, although other central banks have have gone there. So a limit to the Taylor rule in particular and interest rate targeting in general, as I think we've mentioned before, is the problem of hitting this zero lower bound on short-term interest rates. You can't push that policy rate below zero. So if you have conditions like a deflationary recession that indicate that, well, the Taylor rule kind of runs into a limit, and then you have to use some other kind of policy toolkit or framework rather than this interest rate targeting regime. All right, but here we can summarize. What does the Taylor rule say? When inflation rises above target, you raise interest rates, right? You raise it, as we just mentioned, by proportionately more than the change in inflation. When output falls below target, you lower interest rates. And again, based on the structure of the math of the model, you reduce interest rates by proportionally less than the decline in output. If inflation's on target and there's no output gap, the target federal funds rate is the natural rate of interest plus the target inflation. Again, that's the Fisher equation. So Taylor rule, pretty simple math and pretty useful policy framework, pretty easy to understand and straightforward, and presumably doing the right thing policy-wise based on different shocks we could get to growth, spending, inflation, and so on. Did the Fed follow the Taylor rule? Well, Taylor says so. So here's a chart that goes back to 1990 and shows the Taylor rule implied policy rate, federal funds rate, in brown here, and then the actual FOMC target in green. And it looks like the FOMC actual rate target is not too far from the Taylor rule, and it's moving in the same direction. Now, maybe the Fed was too high here in the late 90s when the Taylor rule called for something around a 400 basis point Fed funds rate. The Fed's holding it to 5 or 600. But nonetheless, the path is still followed, and then in the 2001 recession, interest rates come down. Now, a lot of critics, including Taylor himself, will say, right in here, during 2002, 3, 4, 5, the Fed held the interest rate too low. They should have started hiking much sooner than they did. This, Taylor and others argue, contributed to a housing boom and a excessive aggregate demand. And then when the Fed actually did start raising rates here, it was maybe kind of too late, and that helped precipitate a recession. Of course, the recession was mostly due to a financial crisis, which was precipitated by a massive buildup of bad debt in the form of subprime mortgages. And we'll talk more about that as well later on. But arguably, yeah, the Fed followed the Taylor rule, at least loosely, for a fairly long period of time. And that's, during most of that time period, the Great Moderation era, the economy did pretty well. Recessions that we had in 91, 92 here, and then 2001 were viewed as pretty brief, pretty mild, pretty tolerable. So the Taylor rule has a lot of cachet because of that, although not without its controversies. And especially, again, remember, we get into the 2008 recession, the Taylor rule is saying we should have negative short-term interest rates, policy rates, and the Fed can't/won't do that. So now the Taylor rule is looking less relevant, and then the Fed adopts a ad hoc mixture of different policy tools and a new framework. So that is what I've talked about previously with respect to the interest on excess reserves and repos, quantitative easing, and what have you. Okay, let's wrap up the Taylor rule by just recapping some problems of a Taylor type rule, a reaction function. One, simplicity of the rule can rule out effective responses to unusual conditions, and this is of course what occurred in 2008. The Taylor rule runs up against that zero lower bound for short-term interest rates, and the Fed has to start being more creative and implementing other policy tools, including quantitative easing, interest on excess reserves. Fed can only cut rates so far. It's inherently backward looking. It's looking at what we've experienced up till now, and many economists say, well, the Fed should be targeting forecasts instead of data that we're receiving, historical data basically, which we're receiving with a lag. And then, as I've mentioned, the Taylor rule breaks down at that zero lower bound to policy instrument. Okay, now let's wrap up for today's lecture with a rather new concept known as nominal GDP targeting. And this is an attractive concept because maybe it can overcome some of the limitations of the more naive frameworks such as monetary targeting or interest rate targeting, while still being very simple and very easy to understand. Nominal GDP targeting was popularized by a brilliant monetary economist, Scott Sumner, out of Bentley University in Boston. And Sumner, for probably over a decade by now, has been proposing that the Fed should adopt this in lieu of the inflation target that they've been operating on. So what is NGDP targeting and how does it work? Well, let's look at the quantity theory of money equation again. Percent change in money plus percent change in velocity equals a percent change in prices or inflation plus a percent change in output or real growth. What does inflation targeting do? It targets just this. What nominal GDP targeting proposes is to target this altogether. M plus V would be total spending in the economy, or nominal GDP. And of course, these together, whether we think about it in terms of the M plus V side of the equation or the P plus Y side of the equation, well, that's nominal GDP, right? That's total spending, whether we think about it in terms of the money side or the expenditures and purchases side. Now, the FOMC would choose a growth rate or a growth path and then take regular monetary control steps, whether through open market operations, quantitative easing, interest rate changes, what have you, to achieve a stable growth rate or growth path of that nominal GDP variable. Here's the rationale for NGDP targeting. When you target inflation and real growth together, that allows for flexibility in inflation to absorb positive or negative real shocks in the economy while containing consistent and reliable aggregate demand growth, right? We could lump these together and call this nominal GDP growth, and another term for that, of course, would be aggregate demand or total spending, right? Those are all basically the same thing. Again, we'll think about this in terms of that quantity theory of money equation. So let's say, as our baseline, we have 5% nominal GDP or total spending growth. And again, this together, we'll think of this as nominal GDP. And then over here, we'll think of breaking nominal GDP down into its components, the inflation rate and the growth rate. Okay, so our normal situation, our baseline, and again, based on long-term averages and explicit desired targets, 3% real growth, 2% inflation, so we'd want 5% nominal GDP growth rates. Now, let's think about what happens if a negative supply shock hits the economy and drives the real growth rate down to something like minus 2%. Okay? Keeping a target of 5% for nominal GDP growth, we're going to have to let inflation rise to 7%. Okay? To offset that decline in real output, we're going to have to let prices rise. Why is that preferable to a strict inflation target of 2%? Well, think about if we kept inflation on target at 2% and had a negative 2%, a negative real shock here, a negative 2% in real growth, well, then nominal GDP growth would fall to 0. And why is that not preferred? Well, two reasons. One, total spending becomes very volatile here, and it becomes difficult for people to form stable and consistent long-term expectations about the growth of spending and prices. Furthermore, you'd actually want that inflation rate to increase in the face of this, the bad news of the real shock, and tell people that, hey, prices have gone up, so you should work hard to curb consumption and or find substitutes. Right? So the inflation signal is a useful real price signal here that might be distasteful because inflation is rising, but nonetheless reflecting the reality of a negative shock that we all need to now adapt to and live with. And Sumner's going to argue that, well, inflation targeting is politically popular because people don't like to see inflation go up, but there are times when we should allow inflation to go up because that's reflecting a reality of changes in the economy. And nominal GDP targeting allows the monetary authorities to go ahead and let that happen without explicitly stating that they're allowing higher inflation, because all they're concerned about is total spending, right? So Sumner's arguing that this situation up here is preferred to this, even though the inflation rate's higher, because that inflation is both useful and it's very beneficial to keep long-term spending growth on a stable and predictable path. Let's think about the flip side. Let's think about a positive shock here, so where real growth is now rising above its long-term trend. If we were in a nominal GDP targeting regime, we're going to keep total spending growth at 5%. All of that spending growth is now absorbed by increased production of goods, so now the inflation rate can fall to 0. Whereas if we were to stay on a rigid 2% inflation target, we'd have to see nominal spending growth rise to 7. Why is this preferred? Again, well, it's better according to Sumner and his like to keep total spending on a consistent and stable growth path. And then it's useful for consumers and producers in the economy to see a reduction in inflation, a disinflation, and potentially even a slightly negative inflation rate here to signal that with increased productivity, prices are now not rising or possibly falling, and that's a signal to go ahead and increase spending and consumption. So allowing the inflation rate to fluctuate based on real shocks is very useful. It sends a signal to people, but we can still keep the path of prices and spending and wages and so on a stable long-term path. These are short-term fluctuations in the inflation rate. We can keep total spending, wage growth, etc. on a stable long-term path. So it's kind of the best of both worlds. And to summarize, we'll talk about benefits of NGDP targeting. One, it's simple. It's one target can replace a dual mandate. Two, it allows for greater stability. Even though, as I just mentioned, we give up some volatility in short-run inflation rates, we achieve greater stability and long-term path of total spending, price, and wage growth. And finally, and this is a very important aspect that Sumner brings up, is that it sidesteps some specific problems of inflation rate targeting, namely a political bias for low inflation, which has its drawbacks because, as we mentioned, sometimes higher inflation is necessary, and some problems with our inflation metrics that Sumner is very critical of and maybe don't get enough attention in macroeconomics. Sumner mentions the fact that CPI doesn't accurately portray housing costs, and it's a pretty well-known fact as well that CPI doesn't account accurately for consumer substitution. So when prices change, people substitute into different products, and that actually moderates the effects of inflation. So there's some problems with the inflation metrics that, if we're using inflation targeting, are going to lead to maybe some flaws in monetary policy making. Let's conclude. It's most important for central banks to pick a target that's relevant and proper for macroeconomic stability, and then stick with that chosen framework in order to maintain credibility. If a central bank has the right target but no credibility because it doesn't stick to it, well, then that target or that tool, that framework is not very useful. So credibility is of tremendous importance, but then again, if a credible central bank has the wrong target, well, they could take the economy down with the full confidence of the market and the public. So having the right tool is pretty important as well.